Hello and welcome to Money Control's live stream. You're watching a fresh new edition of Opening Bell with me, Lavisha Darad. And the conflicting views, opinions around the war in the West Asia continue. After yesterday, we saw that the market saw a severe sell-off with Nifty plunging below that 22,600 odd levels, and even India VIX indicating heightened volatility. We had the US President Donald Trump posting on Truth Social that over the last 2 days, US and Iran have had a very good and productive conversation regarding a complete and total resolution of hostilities in Middle East. He even went on to say that in the social post that he has ordered the Department of War to postpone any and all the military strikes against the Iranian power plants for a 5-day period. And as a result of this post, we saw that the oil prices wildly tumbled by about 14% to hit an intraday low of $96 per barrel. So yes, remember we were hovering above that 115, and that from those levels we came down to about $96 per barrel. But right now you can see that Brent is once again cruised above that $103 per barrel. We did see that after soon of these reports that came out, Iranian officials refuted Trump's claims. We had Iranian Parliament Speaker Mohammad Bagher Ghalibaf, who said that no negotiations have been held with the US and fake news is being used to manipulate the financial and oil markets. Apart from him, even the Iranian Foreign Ministry dismissed any such claims of negotiation with the Washington, saying that over the past 24 days, Iran's position on the Strait of Hormuz and the terms for ending the war remain unchanged. So yes, a complete denial and dismissal of what US President Donald Trump was saying, and that also got oil prices back above that $100 per barrel. Right now, if you saw the screen, Brent cruised above that $103 per barrel. But the risk-on rally remains resilient across the global markets. The US markets closed higher on the back of Trump's de-escalation remarks. We even saw Asian markets also opening with a good set of gains in today's morning session. We saw Hang Seng up and about by about 2%. Nikkei also traded with good set of gains. Even for our markets, the GIFT Nifty is suggesting a very gap-up start. For now, it looks like, GIFT Nifty suggesting about 400 points of an uptick on the index level. But the conflicting views continue, and we'll watch out how actually the markets digest all of these news going into today's trading session. But before we move on to the show, let's listen into this bite by US President Donald Trump, where he claims that there could be an extraordinary idea of a joint leadership of Iran, and what he told to reporters in yesterday. So listen into this conversation.
They called. I didn't call. They called. They want to make a deal. We'd like to make a deal too. We're going to get together today by probably phone, because it's very hard to find a country. It's very hard for them to get out, I guess. But we'll at some point very, very soon meet. We're doing a 5-day period. We'll see how that goes. And if it goes well, we're going to end up with settling this. Otherwise, we'll just keep bombing our little hearts out. Well, I just want to have as much oil in the system as possible. And we don't even know if Iran gets that money. Frankly, I think it's very hard for them to get it. But you have ships that are out there that are loaded up with oil. Rather than keep it there, I would rather see it go to the system.
Will Iran still be able to control the flow of oil?
Be jointly controlled.
By who?
Maybe me. Maybe me.
You want the United States to be
Me and the Ayatollah, whoever the Ayatollah is, whoever the next Ayatollah. They called.
So yes, that's what the US President Donald Trump has been saying. When the reporter asked that who's going to take control of the Strait of Hormuz, he's been saying that Iran and of course US and of course whoever the next Ayatollah in Iran becomes. So yes, that's a key statement that came in from the US President after announcing the 5-day window for Iran. But Israel's Prime Minister continues to say that the war against the Iran will continue, despite the US President saying that, announcing that 5-day window, saying that Israel will continue to vow against Iran and will continue to safeguard the Israelis' interest. So listen into this conversation by Benjamin Netanyahu.
Earlier today, I spoke with our friend, President Trump. President Trump believes there is a possibility to leveraging the mighty achievements obtained by the Israel Defense Forces and the US military in order to realize the goals of the war in a deal that will preserve our vital interests. At the same time, we are continuing to strike both in Iran and in Lebanon. We are smashing the missile program and the nuclear program, and we continue to severely strike Hezbollah. Just a few days ago, we eliminated 2 more nuclear scientists, and there is more to come. We will safeguard our vital interests in any situation.
So I guess while the US has announced a 5-day window, Israel keeps the barrage of strikes on Lebanon and targets Beirut and suburbs. So interesting range of developments and from that is coming in from the West Asia. Of course, there's a conflict of narratives which is coming in from both Israel, Iran and even US at this point of time. But before we move on to the rest of the programming, let's take a quick check of the top headlines this hour. US President Donald Trump announces a 5-day pause in attacks on energy sites after talks with Iran, which he described as very good and productive. Iran, however, flatly denied that any such talks have taken place. Benjamin Netanyahu, meanwhile, says he has spoken with Trump, who saw a chance of an agreement with Iran, but added that Israel would continue its strikes against Iran and Lebanon. Oil prices edge higher after tumbling 11% last night as Trump extends Iran ultimatum. Markets are also pricing in the potential reopening of the Strait of Hormuz. The Dow surges 600 points in a relief rally after Trump says US and Iran have had a productive talks despite Iran's response saying that the claims were false. NASDAQ closed up nearly 300 points. Meanwhile, the Asian markets tracked gains on Wall Street, opening higher, and the GIFT Nifty is also indicating a gap-up start for our own markets. Market regulator SEBI approves a new code to avoid conflict of interest among its whole-time members and officials. This follows the controversy over investments made by former SEBI chairperson Madhvi Puri Bhuj. In some relief for exporters, India ends curbs of 50% on export incentives, reversing an order from February 23rd. The decision will be valid for exports up to 21st March. All right, so those were the top headlines for you. And of course, the US president has been claiming that Iran wants to make a deal. It's halted the strikes for 5 days, but we'll watch out how this entire narrative gets digested by our own markets. For now, the GIFT Nifty has been pointing out a gap-up start for our own markets. But let's understand how all of these cues will be impacting in today's trading session. On that note, let's quickly move on and get in our top experts of the day. We have Dharmesh Kant, who's the head of research at Cholamandalam Securities, joining us. And we have Shrikant Chauhan, head of research at Kotak Securities, also joining us. So let's take in the cues of how today's trade setup, of course, looks like, given that we are seeing a gap-up start for the Indian markets at this point of time. But yes, from the trade setup, it definitely looks like, the risk-on rally could be likely, given that the US markets also closed higher in yesterday's trading session. All of the major averages did see their best sessions since the early February. And apart from the US markets, we did see a risk-on rally across, and as a result of which, we've seen oil prices also easing off and bond yields also cooled off earlier also. So US bond yields are cooling off by about 4 basis points. And you can see oil Brent crude prices, despite tumbling that 14% odd levels, we are back above that $100 per barrel based on how the conflicting opinions between US President Donald Trump and Iran has been panning out. But apart from this, we have seen that yesterday in the FII and DII sellers, we've seen that FIIs continue to remain the net sellers for the 17th consecutive day. They've sold stocks which was worth about 10,000 crore rupees in the equity markets. However, DIIs trying to cushion the impact and buying stocks which was worth about 12,000 crore rupees in the cash markets itself. But yes, let's get in our experts of the show. We have Dharmesh Kant and Shrikant Chauhan joining us to understand how all of these cues will impact our equity markets in today's trading session. Gentlemen, a very good morning to you. And looks like, we have a reversal on the horizon today after the severe sell-off that we saw yesterday. Dharmesh, I'll start with you. And of course, your first take on the markets, given the kind of battering we saw yesterday. What's the situation that you're reading right now? Definitely a flip of screen today.
Yeah, good morning to you, Shrikant, and to all our viewers. There are too much news flows coming in, and the news flows are conflicting in nature, contradicting in nature. And to my mind, the anti-climax kind of a settlement is very unlikely. Knowing Iran for last 40 years, the way they have been at war with Israel, and they are not the one who will easily bog down. So there's a temporary relief, 4 or 5 days of a window of cool off is there. And to that extent, markets will also show some breather kind of a rallies. But looking at the emerging market, I mean Asian market, if you look at the screen today, they are not so gung-ho about this declaration by Mr. Trump, which is unilateral kind of a declaration which he's making. So we are, I mean, watching it from the sidelines. We are not jumping the gun or throwing the towel today, and it's not all in for us. And
आगे बैठो
it will be a more of a staggered kind of a buying, which we would be suggesting. As of now, maybe a couple of days, even if the market goes up, we will let it pass.
Okay, got it, got it. Dharmesh, Shrikant, let's get in your view also. I mean, yesterday's fall was quite unnerving. We saw about 15 lakh crore of MCAP getting eroded in a single day. India wicks at 2-year highs. Do you think today's rally can be well used to sell for the traders, or what are your first thoughts?
Yeah, good morning everyone. So for market, we are of the view that it is still forming a very clear-cut lower top, lower bottom series. It is finding a lot of resistance whenever there is upward activity in the market that we saw in the previous week. From 23,750 all the way, the market has fallen to 22,900, which is very clear that the market is under pressure. And today also, if we see the market is moving towards, let's say, 23,300 or 400, then there we can expect a good amount of liquidation of long positions. But today's opening, let's say if it is about 22,800, and if it holds about the same, then we can expect gradual activity towards 23,000. So there the market is having next level of resistance. So in the near term, very, very, very short term, if we consider, then 23,000 is going to act as resistance and 22,800 going to act as support. If it sustains below 22,800, then again the possibility of retesting 22,500 is not ruled out.
Got it, got it. Of course, today we are going to see a little bit of a risk-on rally for the markets. But gentlemen, I mean, let's get in your views on some of these crude sensitives, since they'll be back on the focus on the back of crude, back below that $100 per barrel, but it's back above that $100 at this point of time. All of these paints, tires, OMC stocks. What's your take, Dharmesh? They've seen double-digit drop since the war started, and now there could be some relief, but is that going to be temporary for the time being?
I mean, 1 day, 2 day kind of a bounce off, and I mean, some sort of a correction should not be read into. Basically, these are long-term averages which play out on as far as the input pricing of raw materials are concerned, and normally they do in 15 days to 30 days forward booking. So the real pain will be felt in the Q1 of FY27, and there will be pain because they were initially the derivatives were priced on the basis of $65 to $70 a barrel on the crude, and now they will be priced on the basis of averages around 85 to 90 as we speak. So this is going to be higher. Even if it sustains over 100, it will be difficult for these companies. And this is one aspect about the input prices going up. The other aspect is the general inflation in the economy is on the rise, and that will hit the consumption pattern. Summer heats are on, and the report suggests that there will be some shortfall in the rain if it is true. I mean, if it comes through, that will be further pain. So we are not taking much, relief on the consumption theme, be it paints or crude derivatives. There can be small bounces back here and there because of the trading activity which is built into the stock. So those activities will pay out. But structurally, I think more difficult days to come by. It's not that easy, and despite the correction which has been there.
Got it, of course. Some temporary bounce back, that's the key takeaway, Dharmesh. Shrikant, what's your opinion? All of these OMC stocks in particular, HPCL, BPCL, they're seeing the worst monthly fall since the COVID crisis 6 years back. Do you think that the worst has been baked into the stock price, or the oil price volatility is going to keep the near term quite volatile for all of these counters?
Yeah, I think the way the crude prices are moving, they are definitely going to keep entire sector a lot of under volatility, and we need to be careful while adding them, because the reason is that most of these stocks have already fallen to their extreme levels, and from here we can expect some more panic if something goes wrong. But while looking at the overall trend of crude prices and the way there is news flow. Yesterday, after the slight positive news flow, we saw sudden drop in oil prices. So one thing is very clear that these oil prices are higher only and only because of supply shortage. And whenever there is such type of trend, most of the time uh, it remains for a very short time, and later on, after the resolving of that particular solution, situation, we can expect a sudden or massive drop in oil prices. So I think let the clarity come, then we can look for adding some positions in oil and gas related stocks. For the time being, we are specifically bullish on Reliance Industries only. For other stocks, we need to be like very cautious in terms of adding them at current levels.
Okay, all right. That's a cautious view for both of these counters. All right, gentlemen, just hold on to this conversation. Let's take a quick check of the top stocks that will be under the limelight today. We'll start off with HDFC Bank, given that the SEBI chief has said that independent directors must act responsibly, and has added that any insinuations should be backed up with evidence. Now, the chief comments have been coming out after the resignation of HDFC Bank chairman, that's Atanu Chakrabarti, and that's why he's been saying that all of these allegations must be evidence-backed going ahead from here on. So yes, HDFC Bank, yesterday we did see a drop to about the fourth consecutive day. And since the past 4 days, we have seen that the stock has dropped by about 10% itself. We'll watch how the stock moves in today's trading session, so keep an eye out for that. But let's move on to the next stock in focus. That's your Coal India. The company has approved an in-principle divestment of up to 25% stake in southeastern coalfields via an OFS, and the company will also be issuing a fresh equity of up to 10% post the issue capital. Now, the move has been aimed at unlocking the value in subsidiary. But yes, Coal India, that's something that we'll be watching out into today's trading session after seeing about 3% drop in yesterday's trade. But let's move on and talk about the energy stocks in focus. Like we were talking with the gentleman earlier, energy stocks and all of these oil-sensitive, crude-sensitive stocks will be in focus after we did see that the crude tumbled by about 11%, and the crude oil price likely has come off after Trump paused strikes on Iran infrastructure. But the volatility may persist as the geopolitical situation remains quite fluid at this point of time. Now let's move on to the next stock in focus. That's your Interglobe Aviation. The company has appointed Alok Singh as the Chief Strategy Officer, and the move is coming ahead of the leadership rejig at the airline. The focus has been on strengthening the strategic planning function. Apart from Interglobe Aviation, we'll also be having GR Infra Projects, which will be in focus. The company has bagged about 2,000 crore rupees of highway project from NHAI. The project was awarded for a road development in Bihar. Apart from that, we have NBCC India stock, which will be in focus today. The company has secured about 58 crore work order from Odisha-based university. The order will be for a project management consultancy services. And then we have the stock of Dredging Corporation of India, which will be in focus given that the company has appointed Captain S. Divakar as the MD and CEO to serve as the additional director until the next AGM. The next AGM will be held within 3 months of the board approval. So that's the Dredging Corporation for you. Yesterday, the stock saw about 6% fall. But let's move on to the next stock in focus. That's your IRFC. The company has signed about 12,000 crore rupee term loan agreement with HURL, and the loan has been aimed at refinancing its existing long-term debt, and the refinancing will be offering some more competitive borrowing terms from here on. So yes, those were the top stocks for you. But HDFC Bank, gentlemen, for your views, Dharmesh, what's your take? I mean, we've seen in the past 4 days, the stock has seen about 10% fall. And now, despite the management's assurance and, of course, the SEBI chief coming out with those remarks, how do you see HDFC Bank going ahead?
I think the stock price correction has taken our toll. I mean, it's a good correction which has happened in HDFC Bank. And looking at the Q3 numbers, that were pretty well. I mean, 10% kind of a profit growth with credit growth in around 10-11%. With the size HDFC Bank is sitting on 27 lakh crores of AUM, it was pretty well. Asset quality is well contained. And the good point about the entire thing is there has not been any siphoning of fund kind of a fraud in this HDFC Bank. What has been there is, I mean, mis-selling has been reported, which HDFC Bank themselves have taken care of, and the other part is more of a, philosophical in nature. So I think from here on, if one is a buyer for long term, a good time to start acclimating HDFC Bank. I mean, two, three large cap picks, which looks good at this point of time is HDFC Bank, Reliance Industries, L&T, Larsen& Toubro are good value buy for your portfolios.
Okay, all right. Looks attractive at the current levels. Shrikant, what's your take? The stock from 1,000 levels to a fresh 52-week lows of 740 rupees. It's a dramatic fall. Do you believe it's a buy into this counter also?
Yeah, absolutely. As Dharmesh said, we are also of the view that we should look for adding this stock with a long-term view. With a very short-term view, we need to be careful because news flow will remain there. And whenever there is any stock in under any particular news flow, it takes time to revive. At the same time, it remains highly volatile. So for short-term traders, it becomes very, very difficult to take any trade. But if there is a long-term view, then I think these are the level where one should look for taking some long bets because the stock is now very close to its important support levels based on technicals, as well as if we consider the entire long-term chart of the stock, then it is around those levels where it was in the year April 2024. So after almost a period of 2 years, the stock is again available at same price. I think these are the levels where certainly one should look for taking long bet with a long-term view.
Okay, all right. That's the word coming in for HDFC Bank. We'll watch out how the pre-opened rates have been panning out. You can see about 350 points uptick on an index level at this point of time. Sensex also seeing a sharp gap up in the pre-open trade with about 2,000 points of a uptick that is coming in for both the headline indices. So of course, after the severe sell-off that we saw yesterday, the imminent was that the relief rally could be possible in today's trading session. But of course, it's the weekly expiry day, so any jitters can be something that we need to watch out on an index level front. If you look at Sensex right now, it's seeing an uptick of about 1,800 points. And if you look at Nifty also, it's doing well with about 300 points of an uptick. Let's watch how the rates settle in the next couple of minutes. But in the pre-open, we can see some of the counters. For instance, you can see L&T has been surging quite well in the trade. Titan with about 10% gains, ICICI Bank 10%, Bajaj Finserv, all of these counters have been doing quite well. So yes, L&T also doing quite well at this point of time. Let's get in your views. Dharmesh, what's your take? I mean, of course, we have seen that the stock has seen quite a bit of a fall since the war started. And but we've seen majority of the brokerages saying that it's a buy at the current juncture. Even we had management saying that earlier that 5% of the projects where the work has been stalled doesn't significantly contribute to the top line. What's your take for L&T?
Yeah, I mean, the order book stands tall. More than 7 lakh crores of order book is there. Q3 itself, there were more than 1,35,000 crores of order book. Around 50% is from the overseas, and the Middle East is the major portion of the overseas exposure. So going by historical, weight of evidence, after Gulf War, L&T was the one who got the maximum orders from that region to rebuild it. And this time again, there has been a damage out there. So once the dust settles and when, 2 months, 3 months down the line, L&T will again be the front runner to garner the orders to rebuild the entire region. So that is the silver lining to the entire thing. Stock price correction has taken 20% kind of a top line hit. From the top, L&T has taken a hit. And to my mind, if war settles in next 10 to 15 days, then this is a golden buying opportunity for Larsen & Toubro. But if it doesn't, then this 5% can escalate to say 10%, 12% going forward, depending upon how long the delay is there. As of now, things are normal, but next leg can be difficult for this company. So the idea you have to buy it. That view is very clear. How to buy it? You go in for staggered approach. Whatever is your allocation, do 40 to 50% now and wait for some time. Even if you buy 5% higher in a clear water, there is no harm because from there, first this 15% gap will be filled and then the further uptrend will be there. So nothing to lose. Let 5% off the table. and then built on the balance of the portfolio. So but definitely a clear buy based on the current valuation at which is trading around 25, 26. It has come 1 year forward.
Okay, got it. So a clear buy the current levels, Dharmesh. Shrikant, what's your view? The stock is sub 3,500 and we did have a consensus target price on a street level at around 4,000 to 4,500. That's on a fundamental price level, but from a technical angle, what's your take when it comes to near term and of course the medium term?
So yes, here at these levels, certainly it's an attractive stock to buy for, but buy with a view of adding more on dips because war is still not over. Till these things are like there, I'm to say geopolitical tension is there and conflict between US and Iran. I think this stock is certainly going to remain highly volatile. But at the same time, the way it has fallen from the levels of 4,400 to almost 32, 3,300, it is certainly a buy at these levels. It has fallen almost 80%. I'm going to say it has retraced 80% of its entire rally. And now again, it is available at same levels where it was at the beginning of 2024. So most of the stocks have fallen to their quite attractive levels. And with a very short-term view also, I think one should look for taking some long bet with a stop loss at 3250. If there is a long-term view, then it is better to buy at current levels and more on dips.
Got it, got it, got it. But yes, let's move on and talk about the Nifty Metal Index. It was one of the top sectoral laggards yesterday. And the argument is that the West Asia conflict would cap the economic activity and that would reduce the demand for metals henceforth. Dharmesh, what do you make of the fall in the metal stocks, and does this correction warrant us a window to buy into some of these names?
Yeah, definitely, yes. I mean, metals we have been bullish on, and any corrections out there, what we have been recommending is to buy the counters. So valuation-wise, still, I mean, they are nearing plus full standard deviation, but that's a historical valuation multiple for metals when they used to do around 9 to 10% kind of a growth. But going forward, I think around 15 to 16% kind of a growth is likely to be there on all metal companies, particularly those which are inward domestic looking. If so, companies like say JSW Steel or Steel Authority of India, they look particularly good on the Fed space. I think a lot of infra activities is lined up, and most of the pent up completion of infrastructure activity will happen. Though the fiscal constraint is being cited by most of the analysts going forward, and that's the reason why people are turning a bit negative. But I don't think so that will come into the window. At the same time, international scenario will also improve once the rebuilding starts. So Hindalco is our top pick from the non-ferrous space, which has copper, aluminum all into play. Vedanta is again a mining and a beneficiary of any uptick in the aluminum and copper prices. So and JSW Steel and Steel Authority of India. So this four as a basket, I mean, one can play it out, but one should be mindful. You should be buying only on declines rather than chasing the uptrends.
Okay, got it. That's the view, Dharmesh. Of course, Shrikant, but we have seen that in the past 1 month, the non-ferrous names have done fairly worse than the ferrous ones. Explain us this divergence in the fall, and of course, what's the way ahead, and what would be some of the attractive stocks from this particular space?
So for the time being, we have seen rally in almost all the metals. But now the profit taking is happening at every rise. And that is why we need to be careful. But yes, in that space, we like ferrous metals. I think we can expect further more activity because the relative strength is better as compared to other non-ferrous metals. Specifically, we like Jindal Steel and Power, we like JSW Steel, and both are available at attractive levels. We have a target of close to 10-15% higher from current levels. And I think, yes, certainly we should look for adding them. For Hindalco, Nalco, we are now watching that whether they are correcting from their current levels or not. Based on that, we will come out with specific recommendation. But for the time being, it is better to focus more on steel stocks.
Okay, so focus more on the steel stocks. That's the key takeaway. Shrikant, let's get your top trades of the day also. I mean, in this particular relief rally that we might be seeing today, given how the pre-open rates have also been panning out, What are what are your top trades that investors can watch out today?
Yeah, absolutely. I think the market is going to remain in a range. That's the view, and this will help this I would say traders in the short term, because the way the market has fallen in last 3 4 days, now it is going to consolidate. That's my view. So based on that, we would like to go with few power companies, because there we are seeing good amount of buying interest. They are relatively better than other peers or maybe sectors. In that specifically, we like Power Finance Corporation. There we have a bullish view, and currently, if we consider its technical pattern, then it is forming some rectangle sort of formation, which is bullish consolidation. Currently, it is around 398. There we have a target of 420, 425. We can keep a stop loss around 390 for the same, buying at current levels. So buy PFC at 398, 400 with a stop loss of 390, target 420, 425. And we can expect some weakness in Muthoot Finance. Currently, it is around 3,100, 150 sort of levels. But from here again, the stock can fall towards the levels of 2,900. So it's a sale at current levels, Muthoot Finance, around 3,100, 3,150, with a stop loss at 3,175 for the target of 2,900.
Okay, all right. Those are the top trades of the day. All right. On that note, we have to let you go, Shrikant. Thank you so much for joining us, and hope this risk-on rally sustains throughout the day itself.
Thank you.
Thank you. All right. Of course, the pre-open rates definitely looks like, it's going to be a good start for the markets given the kind of sell-off that we have seen yesterday. If you look at the Sensex at the pre-open, it's up by about 1,500 points. Nifty is also up by about 300 points itself. So in just a couple of minutes, we'll be moving on with the open rates as well. But yes, good news also coming in from the Indian rupee front, which is opened with about 30 paise higher at about that 93.67 levels. After yesterday, we did see an intraday low of 94 against the US dollar. So right now, if you see, it's about 93.7 against the US dollar. So yes, with this, let's move on to a next set of conversation. We have Kunal Shadani of Shinhan Bank to decode how the currency movements lies and of course what lies ahead going forward. Kunal, good morning. And finally, some breather for you guys, given the sharp breakdown we saw yesterday, rupee breaching to that 94 against the US dollar intraday. Do you think, based on the current comments, maybe the worst may be past for the currency, but there has been conflicting opinions that is coming in from West Asia?
So first of all, thank you for inviting me for the show. I think first thing which I want to highlight is, as a banker and as a trader, I think we need to add one more risk, that is the tweet risk, to our value at risk, because I think tweets have been moving the markets more than actual movement or the flow of money. So talking specifics, yes, obviously it gives some relief, but obviously the Iran has obviously denied those comments, and I think it is more a fake news kind of a thing, a tweet which has been flowing into the market, though it is from the original sources. Two, three things which we want to importantly know. First, obviously, the FPI outflows has been tremendous for the month of March to the tune of $11.8 billion to be specific. Such outflows were last seen during the COVID times in 2020. In March month itself, where the outflows were around $14 billion. So this is almost the second record highs. Even if you talk about the Asian currencies, we are the second weakest Asian currencies after the weakest Asian currency after the Thai baht, where we have depreciated in 2026 by around 4%. Third important thing is, even if you see the 10-year US Treasury yields, they have been moving towards 4.38%, which obviously intends that the US Fed may keep rates higher for a longer time, which in turn makes capital outflows from the emerging market and Asian markets as well, due to which obviously we are also seeing the outflows. Geopolitical risk continues to, hover around us. There is no clarity. You rightly said it was a breather, but in fact, yesterday after the comment, dollar rupee went as low as 92.95. So if I compare that with the opening today, with some more clarity that not of the denial, then I think it's not much of a breather, to be honest, because it's just a 20-30 paisa move as compared to yesterday's level. For me, I believe this may take a prolonged thing, as in I don't think it will be over soon. For crude oil prices, I still believe these remains on buy on dips and pressure on rupee will still continue to remain. RBI definitely has enough ammunition. They have been intervening at interims, but the strategy is different because now system liquidity is also something which one needs to understand. During March end, particularly GST and advanced tax outflows, system liquidity is not much. So if they intervene heavily, it further sucks out INR liquidity from the system. So maybe some kind of OMOs may be expected. That's what my personal opinion is in order to take liquidity as well into consideration. And in case if they look forward to intervene around 94, 94, 20 levels. For me, importers have a good chance if they are able to see 93, 93 half. I think importers should go for options as the products so that they can protect and participate themselves. And for exporters, keep on hedging in staggered manner. Don't be complacent and don't, see that, levels are just going to move higher. Yeah,
Got
so
it.
over to you. Yeah.
Okay. Of course, the crude oil prices volatility is going to keep the local currency higher, depreciating. But Kunal, is the bigger risk right now the absolute level of US yields staying higher for longer? Because if you look at the US 10-year yields, it's still hovering about that 4.3 to 4.4% band. And does that mean that even if oil cools, the rupee recovery could remain limited from here on?
I personally believe yes, but I think so. Bond market is the backbone for any financial market. But in case if geopolitical risk cools off, I think the bond yields will also cool off to some extent. Thus, it may provide some support. So if we talk about even the dollar index at large, it went as good as 100.54 levels and then retraced back towards 99.30 levels. So I would not say there can be a direct impact on rupee with respect to 10-year bond yields and dollar index, but it comes with a lag. So yes, in case if the pressure remains on bond yields, then definitely rupee will remain under pressure for some more time.
Okay, got it. All right. Just let's address the first rates which is coming on your screen. We're seeing a sharp relief rally across the markets. Nifty opening with about 300 points gain, 1.5% gains coming in from an index level. Sensex also opening with good set of gains of about 1,000 points coming in from an index level. Bank Nifty is also opened quite strongly, 800 points of an uptick. And if you look at the broader end of the markets, both the Nifty mid cap and small caps have been, edging higher. Nifty mid cap is up and about by about 2%. Small caps also doing well with about 1.5% gains coming in for there as well. The fear index, which is your the India VIX, has relatively cooled off. It's seeing a sharp fall of about 6% at this point of time. But given the kind of conflicting remarks that we have seen over the West Asia, whether this fear gets digested well into the markets is something that we'll be watching out later in the second half of the trading session also. But from a sectoral perspective, it's a sea of green. If you look at Nifty Auto Index, that's been leading the charts with about 2% gains. Apart from that, Nifty Metal Index, which was one of the worst performers in yesterday's trading session, has gained by about 2% itself. Apart from that, consumer durable stocks have also been doing well. If you look at Nifty IT Index, that has been resilient today with about 1% gains. Metal Index with about 2% gains, like I mentioned earlier. PSU banks, pharma, all of these counters have been doing quite well. But let's take a check of how the gainers and losers pan out on an index level. So yes, a majority, about 49 stocks, about 50 stocks, all of these Nifty 50 stocks have opened in the green. And some of the gainers looks like on your screen, Shriram Finance with about 4% gains, Asian Paints with about 3% gains, Titan has been doing well with about 3% gains. Apart from that, you can see the likes of Eicher Motors also with about 2.5% gains coming in for there. Bajaj Auto with about 2% gains, Ultratech Cement with about 2% gains. So yes, it's a sea of green for the markets in today's trading session. Even from the Nifty 500 pack, you can see that about 475 stocks have advanced, while just 25 stocks remain in the decline. So yes, all in all, it looks like the market breadth has, definitely improved after the worst sell-off that we saw yesterday. But among the Nifty 500 gainers and losers of what is doing well in this market, let's take a quick check. Among the gainers, you can see the likes of the top gainers. Electra Green Tech has been doing well, Tejas Networks, Birla Soft, Shriram Finance, GMR Airport, some of the gainers on the Nifty 500 index. Apart from that, losers, you can see Metropolis, Power Grid, Trident, some of the other losers on the back of that. So yes, it's a mixed trade for the markets, but yes, the advanced decline ratio definitely speaks well for us, 2:1 of where we stand as at this point of time. But yes, apart from that, you can see among the BSE mid cap also, you can see for the likes of Bharat Forge has been doing well, RVNL, Tata Communications, Motilal Oswal, some of the other gainers on the Nifty 500, and of course the mid cap index at this point of time. But yes, let's get back to our earlier conversation that we were having with the rupee. Kunal, you were mentioning about the bond deals. And of course, what's the realistic band for rupee that you're working with? I mean, is it going to be 91, 92 levels anytime soon, given that oil remains above that $100 per barrel?
So a couple of things here. If we talk about the March end phenomenon, so basically, usually it's a book closing and for India specific financial year end. So the demand for INR definitely increases during the last week of March. So I believe some kind of appreciation may be seen because of this phenomenon. So if you see last 10 years, I think 7 or 8 times out of 10 times, we have seen appreciation in rupee during the last week. So considering that, we can possibly see some appreciation. If we talk about the overall band where we look is broadly 92 to 94 half is where we think the play will be around. If it goes below 92, I think RBI themselves may want to build their FX reserves once again, because currently I think it's standing around $709 billion, which dipped from almost $728 billion. So I think that could be an opportunity for them in case if it dips below 92 levels. So broadly 92 to 94 half is what I'm looking at.
Okay, all right. That's the level that we need to watch out for in the rupee also. But yes, on that note, we have to let you go, Kunal. Thank you so much for your time and joining us.
Indeed, my pleasure. Thank you.
Thank you. All right, that was the rupee for you. And of course, we have appreciated against the US dollar in today's trading session. But let's watch out whether or not this, pans out and whether or not rupee sustains this good moves from today itself. But yes, coming back to the equity front, we have been seeing a relief rally across the markets. Sensex and Nifty, both of them, showcasing good set of gains with about, on an index level, we are seeing that Nifty is up and about by about 250 points, a percent gains coming in on an index level, and even Sensex is up by about 800 points. But we have cooled off from that opening highs. Sensex is now up by about 800 points and Nifty is also up by about 250 points. And you can see that India Wix levels has also, cooled off from where we started earlier. Right now, it's showcasing a fall of about 3.5% at this point of time. But yes, let's get on with our big market voice segment to understand and, of course, talk about markets, more about markets and, of course, what lies ahead. Joining us, we have Nitin Bhasin, who is the head of institutional equities at Ambit, who's joining us. Nitin, good morning. So good to have you with us, and just on a good Tuesday for that matter, after yesterday's big market meltdown. Clearly, the picture has reversed from yesterday, but the question now is that how durable is this rally? Your first thoughts on today's scenario and, of course, the conflicting opinions that is coming in from the Middle East.
Hi, good morning. Thanks for having me here. This reminds me of exactly 1 year back when Mr. Trump was, changing tariff, and the word tariff tantrums got coined at that time, that you could not form a view on how the tariffs today stand and tomorrow could change. Perhaps the Middle Eastern war is also becoming something like that. And clearly, when the market opened up at about 450 to 500 points, Nifty higher today morning, and then coming down to today, what you just mentioned about 250 points, clearly shows that the market by itself is also skeptical about such comments of, what Mr. Trump said yesterday, that US could be pulling out from Middle East soon, or Iran perhaps not confirming that. So I think we'll have a time of such conflicting news, what we saw last year in Trump tariffs. This time we'll perhaps have to live with the Middle Eastern thing. And what I make of it today is that market's still not comfortable. Clearly given away its morning gain, market is clearly saying to us that things can be recovering in the near term if the war stops, but the damages that this war could have done in the last 3 or 4 weeks to energy prices, supply chains, or beliefs for certain things, or liquidity movement around, could have got damaged, and that might actually be seen in the times to come.
Of course, of course. Nitin, like you mentioned, of course, the risk sentiment still prevails given the kind of uncertain times we're at this point of time. And oil continues to remain above that $100 per barrel. Yesterday, we did see that it slipped below those levels, but it's back above that $100. And I was reading some of the brokerage reports that said that every $10 rise in crude is going to add about 35 to 40 basis points to inflation. So in this market scenario, when the dollar is getting stronger, yields are also edging higher, what does it mean for capital inflows towards India?
So, we have to see that in the last 50 odd years, such energy crisis because of war in the Middle East has happened twice. And perhaps many of us don't have the memory pre-liberalization or what led to liberalization, what was the backdrop of the energy crisis prior to that. So clearly inflation was out of whack at that point in time. Perhaps this time around, at least we know that we are not carrying a high inflation getting into the war. But crude clearly can play a spoil sport in the next 1 year in India. We know that this can actually have an impact on both fertilizer prices, food prices, what the government might do to the fuel at the pump. So hence, clearly, investors were already worried about India's lack of participation into the AI rally in terms of A, inputs, or B, in terms of technology. Yes, we will become consumers of AI for services industry. But prior to that, investors were worried about it. There was a sort of a growth moderation. The earnings growth in India was not accelerating. And we've seen that whether it's flows, both FPIs or FDI, we are in a very different situation as compared to what we've seen ourselves in the past. Whether, FPIs were negative, and more importantly, what I've been highlighting for a while is that the gross FDI may be holding up really well, or in line with its past, but the net FDI was not improving at all, despite the economy growing. So clearly, capital is not preferring India if inflation rises, if the valuations still, which are not very, very attractive right now, though they have moderated in the last 1 year or so. I think we'll have to wait for a little bit more. Remember, all of this is also creating pressure on the Indian rupee. So I'm not very sanguine about the foreign flows right now, both FPI and FDI, given the present scenario.
Okay, got it. Nitin, from a valuation standpoint, where do we stand? Because we've come off 15% from peaks on an index level. So for us to get to a deep value market, do you think that there is more fall warranted, or the current juncture still looks favorable?
So, deep value, I think, is a mirage for our country. I think it will be difficult for us to get there because the funds flow that the local market is generating from within, the Indian savers have become the dominant player. And you know this, despite all what's going on in India for the last year or so, the funds flow from the local savers continues to come to the market. So hence, in that context, valuations are finding, not a free fall zone. Valuations are perfect. Perhaps the SIP investor is providing support to the valuations. But I think there are still pockets taking shape where value is emerging. I still believe that some of the large cap companies are, perhaps now becoming value. We've seen that in the last 5 or 6 months, dividend yield stocks like Coal India have actually outperformed the market by generating positive returns. We think that large cap, mega cap companies are where people should actually invest for the next 6-9 months, because at least from the relative valuations, they're not very expensive. And number two, they've got very good franchises. And some of them, their earnings risks are not very high. Now, given all this, what we're seeing, whilst the valuations may look good, the earnings estimates also need some moderation in India, at least for the small cap, mid cap, because clearly you and I understand that this can have an issue on inflation, it can have issue on volume growth, it can have issues on EBITDA margin. So earnings estimates moderation will not make the valuations look that cheap. What perhaps if you were to carry estimates of 1 month back. So hence, what will it take for the market to become value? I think another 15% or 10% will perhaps can qualify as deep value, but will it happen? Will it go down that much? I don't know. What I can only say is not the best time yet to start massively owning up small cap, mid cap, but there are certain pockets of certain sectors which may be emerging. We in our house also have upgraded some of the stocks very recently, which perhaps have corrected 30-40% from the tops. They are looking good, not as expensive as what they were about 1 year back. But are they the ones to buy today, all of it that you want to buy? I would say we should wait because earning estimates and the impact of the war is yet to be understood.
Okay, got it, got it. But Nitin, are you revisiting your FY27 earnings estimates? Because earlier the street was estimating about 14 to 15% of earnings growth for FY27. What is your expectation at this current juncture with whatever is happening across the West Asia?
Really, I think a lot of, I would say more risk to the mid cap and the small cap, but the number that you shared is more for the Nifty. And within that, 50% of that incremental growth was to come from banks. Let's see if this Middle Eastern tension continues for a little longer period of time. What does it do to the credit profile of India? What happens to the credit growth demand of India? Clearly, I would say, that's the question. That's why you've seen the government come out and have given out some sort of a relief package for MSMEs. Clearly, the risk is emerging over there. So hence, I would say those estimates will need to be revised. But at the same point in time, it could be that the banks start getting a little bit more deposits. If the market pulls back from putting money into the equity markets, perhaps that's a good thing for the banks. There could be companies like Reliance, which actually see themselves go through a much bumper profits, or there could be OMCs, which see definitely a more cut in their earning estimates. So I would say, on a balance, I would be more downward biased to these earnings revisions downwards. But IT, again, remember, because of the rupee dollar closer to 93, 94, people will upgrade their numbers even if the outlook for growth is moderate. So I would say not a very deep cut to that 14 to 17%, but perhaps could settle closer to about 12%, 13%. And we've seen that India or any other market suffers from optimistic biases of estimates in the beginning, then go through revision. And such events are sometimes underestimated. So I would say downward bias, but not a massive cut unless and until this thing continues for more than a few months.
Okay, all right. That's a modest cut. That's what you're penciling in at this point of time. Nitin, let's get to your model portfolio. You've mentioned value retail as your preferred space. With inflation risks emerging, do you think that there could be some disruption to consumption trends? That is something yet to get factored in if indeed the war prolongs to a couple of months like you were talking about earlier?
Clearly, I think, when this model portfolio was built roughly about 2 or 3 weeks back, I would definitely say I was also in the same camp. Could this be a 1 week issue? But at the same point in time, value retail stocks, whether it is Vishal, which we turned our call yesterday, or Trent, which we've turned our call in the past, these things have come down a lot from their peak valuations of about 1 year back or 6 months back. So they appear to us as good franchises, definitely punchy valuations, but deserving valuations. So hence, we've put that into our model portfolio amongst many stocks. But I would say that's only one of the stocks in my model portfolio. You can see that in the model portfolio, we prefer large cap companies, mega cap companies, and a very few discretionary retail companies in our portfolio. On the other hand, the way I look at it is, good market, when they say in the market start believing that the earning estimates are at risk, they start looking for earnings visibility. IT stands out for that. Why? Because growth may be difficult, but rupee dollar support the earning estimates. FMCG, more cash flow to EBITDA, earnings estimates, not very punchy estimates sitting over there. So hence, I would say market, given the flow, would remain in where they find visibility of earning estimates or sustenance of earning estimates rather than chasing growth. But we think we found that a value retail stock like Trent made sense to be having in the portfolio.
Okay, got it. Okay.
But the risks remain,
Okay, the risks remain, of course. Of course, the duration of the war, however much it's going to get prolonged, the risks are going to get even more mounter for our own, macro math and, of course, earnings front also. But Nitin, what about the Nifty IT? Of course, you've mentioned that you remain overweight on defenses. And since the war started, this index has fairly remained resilient. Do you think the worst of the AI-related risks has already been baked into the stock prices? And what's the way ahead?
I think one has to see that the backdrop of the 6 months prior to that, it was not one of the most preferred indices. Hence, perhaps since the war, remember, the rupee has been taking a lot of beating, and the growth outlook, which has already been corrected for most of the Indian IT companies, was already out there as low growth sector. But with the rupee now, perhaps it adds to perhaps the translation income for them. So hence it's holding up. And remember, they're cash generating companies. They don't have a very bad balance sheet as compared to some sectors in India. So hence you could say people have said, okay, it's already there was a chatter about could this sector have been oversold. Now with the rupee coming as a blessing in disguise for the sector, we still maintain that it could be one of the sectors. Would it be a 5-year structural sector? I wouldn't want to say that. But because market is full of participants for next 3 months and 6 months, I would say people should think that in the next 3 months, this sector could be an outperformer. We believe so.
Okay, all right. Nifty IT is something that you believe that can be an outperformer. But apart from this, any other sectors that you think that is a valuable buy at the current juncture and of course from the current meltdown that we have seen in terms of the stock prices?
Clearly, I think, as I said, that we don't say sectors, but pharma as a sector, remember, it is a sector which, again, is sitting on export earnings for itself. But yes, they can go through supply chain disruptions. It can be somehow a little bit of gas companies, though the near term is not looking as good as what it should be. But the long term, if globally there is a lot of supply of gas that comes through, could it help Indian gas companies? So I would say moderate overweight on gas companies in India. Definitely upstream companies like Reliance. I wouldn't say banks right now, but definitely I would say something like IT, as I said, FMCG to some extent. Defensive is something, and then very, very large companies, let's say companies with market caps more than 3% weightage into the Nifty. So I would prefer large caps or mega caps. That is a cohort compared to a sector.
Okay, got it. All right, on that note, we have to let you go, Nitin, but good conversation, and see you once the market indeed, if indeed it recovers throughout the day itself.
Thank you. Thanks for having me.
All right, right now let's take a quick check of how the markets Sensex and Nifty have remained quite resilient. Sensex is up and about by about 950 points. Nifty is also doing well above that 22,800 mark, though it has cooled off from the opening highs, but still remains above that 22,800 odd levels with about 300 points of an uptick. From a sectoral front, it's all of the sectoral indices have been trading with a good set of gains. The first leading in the charts is your Nifty Auto Index with about 2% gains. Apart from that, PSU banks have also been doing well with about 2% gains on an index level. However, the India VIX continues to remain in the cool-off mode with about 5.5% decline coming in for there, but still remains above that 25 odd levels, showcasing that the markets have not priced in an immediate de-escalation of the conflict like Trump was earlier claiming. And some jitteriness has been priced into the markets given the kind of Iran has refuted claims of what Trump had been saying earlier. But let's move on and take some of the street brokerages that has come out in today. First of all, we have CLSA, which has come out with a high conviction outperform rating on ONGC, and they have raised the target price to about 415 rupees per share. They believe that the co has been one of the worst performing global stocks since the war began due to the windfall tax fears and the concerns from the past. But a new law limits the government's power to impose such taxes, and that's why they believe that the stock offers about 65% upside in a crude price scenario. So yes, that's the word for CLSA. And then we have the CLSA on Titan, which is coming in, where they have given out an outperform call on the counter. They have raised the target price to about 4,996, and Titan remains one of the top Nifty gainers of the day today. Apart from that, we have some good notes that's coming in from Nomura on the banks also, where they have upgraded to Kotak Mahindra Bank to a buy call, and they have given out a target price of about 455 rupees per share. They believe that the credit deposit ratio has risen to about 82% versus an average of about 75% itself. And some of the top picks apart from Kotak Mahindra includes Axis Bank, and the others include, for instance, your ICICI Bank itself. Let's move on to the next brokerage note. We have Jefferies on Interglobe Aviation. They've given out a buy call on the counter, target price of about 6,140 rupees per share. They believe that the earnings will be depending on the West Asia tensions and the jet fuel prices, but currently supports a 10 to 11% ask growth estimate for FY27. So yes, those are the rest of the brokerages. Do skim through some of them. All right, those were some of the top brokerages for you. And of course, the risk on rally has been imminent across the markets. And of course, the market breadth stands to about 2:1 for an advanced decline ratio. But with that, we have come to an end of this edition of Opening Bell. Don't forget to tune in at 3 o'clock for closing, and we'll be discussing how the market has developed and what the stocks have been in focus. But before I let you go, do listen into this wonderful conversation by Sushil Kedia, where he talks about that Nifty can climb up to 27,000 mark once geopolitical conditions stabilize, and why he thinks that the IT stocks are some of his top preferred bet.
We have begun starting, nibbling into IT stocks, all of them. Long term में TCS यहाँ से 4-bagger होगा कि नहीं? That's a call, stupid to answer today. But we are looking at a 40% rebound in all of these IT stocks by the time Diwali or New Year comes. And a Maruti, which we were like very bearish on at the last high. And there were surprises everybody was making. Why such a call? So the best reasons for something to happen are known only after that has happened. We are now again looking for a Maruti to go into a new all-time high. Tata Motors passenger vehicle to again go into a new all-time high. Trend, which because of the tepid growth numbers and all, and the speculative excess for which it had gone to 8,000, is available at 50% of the value today. Maybe over the next 3-4 years, Trent might turn out to be the best investment somebody made in this market, bro. And HDFC Bank, amongst all the banks, for a year we got ridiculed completely कि HDFC Bank हम लेंगे ही नहीं. In the next market fall, HDFC Bank will be the worst punished. That has come true. And not just because that call has come true. Now the charts are compelling, and anybody who takes an investment decision in HDFC Bank might actually get a chance to sell it around 1100 again, which will be an all-time high. So these stocks are delivery buys for a long haul. Maybe a 1-year cycle is starting in them. Reliance, Adani Enterprises and Adani Ports have not fallen into a new low. They are still making a higher bottom than the bottom seen already 3 weeks ago. So if the market reverses, when the Nifty reverses, these will be the first stocks on which we will recommend leveraged bets to our clients. Bharti and Eicher are still in a very strong uptrend and have only made a mild correction. They will be the first ones to go into a new high. Bharat Electronics is just making one final dip in the long-term trend. It's just making one more further dip to complete this correction. This will also rush into a new high. So now Axis Bank and your Kotak Mahindra Bank those are the ones that will really ricochet back into a very wild short squeeze. Bajaj Finance, Bajaj Finserv that we have marked have completed a 10-year long-term bull market cycle, and for several years it will remain into a wild trading band. They've come at the lower end of the band, and Bajaj Finance and Bajaj Finserv might actually push Nifty most for the short-term trading cycle of a 20% rebound. So if L&T goes into a new high, SBI, ICICI, they'll all jostle back up. JSW Steel, or for that matter, Tata Steel, or for that matter, every metal stock, we will continue to be remaining bearish for the rest of the year. But in between, itne peet diye gaye hain, they are also going to now make a very sharp short squeeze. So if an external also have kept in a short squeeze category only because we have an internal recommendation to our clients, eternal is going to a new high, double ho jayega yahan se, but again it will collapse back. And all of these stocks your audience can refer back later. So it's only Dr. Reddy's, NTPC, Titan and Apollo left for a further serious decline, and a hero motor only that we are not bullish on us and are seriously looking to play a bearish call. ONGC, Sun Pharma, SBI Life after some pullback will be again good for a buy. And Indigo that we made a call at all-time high is going to drop 50%, has done one big round of its fall. And I'm expecting even a 10-15% rebound on Indigo. So within Nifty, then when there are so many different movements each stock is doing. So Surbi, we should meet another day to discuss the difference between PSU banks and the normal banks, and you know why metals are still looking so bad. You know, let market evolve, let a bottom be placed. But broadly speaking, even within one index, there are so many variations. So for us inside this tumult, the one thing that is screaming at us is FMCG and IT. Quickly, FMCG and IT are always the first place to which when market, whenever in the last 20-30 years of history that I have studied on charts and on other things, that whenever markets come out of that deep fear, the first place to find a sigh of relief and solace is the fund managers rush into safe bets of an FMCG, and this time maybe in IT it's only the unknown hands that will go, but the same pattern is visible on charts. Sabse pehle ye dono Bajaj twins, FMCG and IT, will give this market a relief, and then you know the rest of the things will start falling in place.
So that's really comprehensive, Sushil. Just on L&T, because I mean that's been the poster child of this war in terms of the bear attack, right? It's down some 20%. For L&T, do you expect it to revive along with the rest of the market? Will it still be an underperformer? How badly has the chart structure been damaged on Larsen & Toubro?
To answer this question, I like to refer to this chart. If PCR is showing it, so we have a forecast for a long time that L&T will be eventually going to 2800 also. I've gone on public record with your associated channels, CNBC, Awaz. In this zone we spoke about price going to 2800, but nothing moves in a straight line. Ek round ka jo harakiri ho chuka hai, I think we will again go back into a new high and then resume the back move to 2800. See, even on Nifty, our call is, if the reversal comes, which is not yet come, so don't take it as a secret. If it comes, we go back to about 27,100, 200. Yeah. Then again into the first quarter of 2027 or by Christmas, we again come back to the current levels. That's when L&T will come back perhaps to 28,000, 2,800. And after Nifty goes to 2,700, 27,000 comes back to 22,500. After that in 2027, we are still maintaining a massive bull market of a proportion that we've been used to, the India shining story, 32,000 ka move on Nifty. After we go to, see, this is the Nifty chart, we go to 27,000, come back to 21,500 maybe, and then next year, subject to further reconfirmations and changes as the market may dictate, we still are keeping our cards open that investors can mint money in 2027. We will have to navigate properly both the short and the long side of the market through 2026. We have begun starting, nibbling into IT.